Good afternoon. This is Tom Alexander. It is Saturday, September the 11th, and Monday is going to be a really critical day, and we're going to expound on the information that's in the report and give a few more details on a couple of areas. And starting with the view of all four, these are the futures contracts of the four U.S. primary trading indices. There are a few things to point out here. Okay. For one, we broke out of a balance area in the ES, and that break was really on the 9th. We broke out of a balance area on the 7th in the YM right here. And this was discussed in last weekend's report, and there's a leak. There is a link to last week's report and the 3 prior weeks at the top of the report that you received. I encourage you as a good learning tool to go back through those, and you can see what was said and how things have turned out. Now, coming into this week, the NQ had stubbornly refused to confirm the fact that the other indices had broken down very important levels as highlighted in last weekend's report. Well, Friday, we got that break in dramatic fashion. So what you have now, especially in the NQ, you have the beginning of what should be the beginning of an initiative move that's sharply lower. Typically, initiative moves are relentless, particularly early. Now, there are a few confounders in here, as usual, with stock index futures. But I see a lot of people expecting this thing to turn around on a dime, and it may do that. We'll talk about that as we go in here. But I am giving the benefit of the doubt to the downside until proven otherwise. I think there could be considerable downside between now and a pivot low. However, I think that pivot low could occur very soon. I think it could occur as soon as noon on Monday. We'll see. Other thing I'll make note here is that the Russell is just amazing in its ability to go net nowhere over the past year, and that continues. Okay, so let's take a look at a couple other things in here. This is a chart of the ES continuation chart that I put in the report. Cash chart would effectively look the same or almost identical. And what is striking about this chart is how remarkable the bid has been in coming into this market anytime there is a dip. And we see this going back all the way into last fall. It's just been amazing to watch these dips occur, and then following the dip, you have just an immediate rip. And it has occurred in all degrees of time. It's occurred on the short term, like we see in here. And then it's continued in the more wide-ranging swings like we have here. None of these intermediate to wide-range swings since, gosh, going back to the March 20 low has been taken out. Not a single one. That's remarkable. Well, the next one to keep an eye on, and I think that this is a reasonable target for the present decline, is this August 19th low. If we were to close below this August 19th low, that will be something that is occurring that has not occurred since the March 20 low. Now, let's take a look at the profile view of the indices. Okay, these are the cash profile views. And I have split it, the typical profile view, market, quote unquote, market profile is, all the market profile people will put the blob up here. They want to get this Gaussian shape, and they're tethered to it. And that's not the purpose. That wasn't the initial purpose of the profile graph. The profile graph was initially designed to reflect the auction. And the mistake in Stottlemyre's early work was putting too much emphasis on that profile graph, and that continues today. But from an auction market perspective, when you're using the profile graph as a means, as a tool, as a means to an end, as opposed to an end in itself, it can give really useful information. So I have split out. This is the September auction. This is the August auction, and we're in an elevator shaft. Now I realize there is a high volume node. You know, there's a value area right in here. But so what? That's not the most salient point about the chart you see on the screen. The most salient point about the chart you see on the screen is the fact that we have all this extraordinary conviction to the upside. Now we have, as of Friday's close, we have closed below a level that had a chance to be at least a short-term low. Now it's possible that what we saw on Friday was just an overshoot, a stop run at this level. That's possible. But there is nothing from an auction market perspective that can slow this market down until you get all the way to here. Now be careful with what I just said. That doesn't mean we don't stop here in a rally or we don't stop here and rally, but it will be coincidental. It won't be some magic. When you are in an elevator shaft, previous conviction, it increasingly, it will increase the probability the deeper you go into that elevator shaft of retracing the entire move, which would bring us down to here. This is the most, below here, this is the most important auction market point in the S&P. Now, that doesn't mean we get there on Monday or Tuesday or Wednesday or whenever, but this is, from an auction market perspective, the next important downside level. Okay, let's take a look at the NDX. And the NDX has a higher level. This would be the level here. Now, below this level, you're in an elevator shaft that extends all the way down again to the August low somewhere in here. Right? And I'm not making predictions. I'm showing you auction market levels. If you follow these reports, and if you've been following these reports, you will see how uncanny it is that these levels prove to be important. And there are 4 reports in the one that you've been sent. You can go back and see for yourself. Okay, let's take a look at the Dow. And I know it's in here. Here we go. The Dow has closed below the entire month of August and is in the July auction, and it is in the elevator shaft of the July auction that is considerably lower. Now, what would invalidate this view? Well, what would invalidate this view is if we see an expansion in breadth above, okay, above Friday session highs. I'm not talking about a close above Friday session highs. I'm talking about a close above Friday session highs and then an expansion in breadth. That's what it's going to take at this point to confirm that we put in this, the next great dip low, and we're off to the next rip to new all-time highs. Okay, let's find Mr. Russell here. Mr. Russell Cash. And here's Mr. Russell Cash. I'll split this out. This is Friday's high. And again, we have to see it close above this level and then an expansion in breadth to get excited about any upside potential in the Russell. The Russell did close on Friday, not too far above its next key reference area to the downside. Below this area, it's all the way back down to these balance area lows. The Russell has been in a balance area for the entire year, beginning at the end of January to present. Okay, now let's look at the internal space. Now, last week, I pointed out that any low should be a temporary low. And I do think that we're going to see higher highs ultimately following whatever retracement correction we have in here. But I was a little bit thrown that we got this drop so quickly after making a momentum peak in the 10-day and the 5-day moving averages. Now, there was this divergence in breadth, but I was got fooled a little bit, expecting a little bit more out of this market because of this huge expansion in breadth. This was the greatest expansion in breadth we'd seen in months. Now, because it sort of failed, it could mean that that was a blow-off prior to the most substantial correction that we've seen, I don't know, at least this year, maybe since March 2020, who knows, that remains to be seen. But what we have not seen yet is anything resembling during this decline of capitulation to the downside, even short-term capitulation. We have, as of Friday's close, we have 4 consecutive days of closing negative breadth. That's very unusual. And let's drill down into this a little bit, and we'll go to a page that we refer to in the live trade room daily. And that is, oh, here it is on a different screen, my bad. Right here. Now, this is a 30-minute chart of the ES, but it's day session only. So it's just cash session of the ES trade. Here you can see breadth. Now, breadth close, it's hard to tell from this particular view, but breadth closed on one. I'm not counting the Labor Day trade that occurred during the day because the cash market wasn't open. But 1, 2, 3, 4, 5 consecutive days now, breadth has closed in negative territory. That's really, really rare. I don't know of an instance where it didn't produce almost immediately an attempt at a strong rally. So that's why I think time-wise, we're close to a significant low. Now, what has me thinking we could see an early washout that perhaps begins in Globex into Monday morning that might be over by Monday noon, I'm just guessing here, is that breadth has been so, it's just held up. There's no sign of capitulation, even intraday. Now, you'll occasionally get these days where breadth doesn't close at negative, 16, 17, 18, negative 2,000, but during the trade day, it traded there. We haven't had that. The lowest reading in breadth during the decline from the high has been negative 1262. Now let's go back. I'm going to scroll through this chart and just show you previous pivot lows. And there is not a single pivot low that did not trade intraday lower, and usually considerably lower than we have seen so far in the decline off the high by the stock indices. All right, this was back in August, and we got as low as 1,800, almost 1,900 intraday. This was the low back in July, and intraday we got down to negative 2,500. This was back in mid-June. We got down to negative 1,700. Now this was a pretty mild contraction in breadth, and it did actually lead to an extraordinary rally into this high. So maybe what we're seeing is like this. It's possible. I want to point out the potentially bullish along with making the bearish case, but I want to be unequivocal. I think as we head into Globex, and without the benefit of seeing Globex, that I sort of favor the washout scenario, maybe 60-40% over an immediate rally attempt. And that you can take that handicapping with a grain of salt. But what we're seeing here, these are facts. All right, so we had a little teeny minor
pivot here, but even this teeny minor pivot reached a negative 1,600, almost 1,700 intraday. This was sort of a double bottom, negative 2,000, and that came against two other negative 2,000 readings, not too far apart. This was a relatively minor low, negative 1,900. Here you had minor pivot lows forming, negative 1,800, several of them. This was negative, almost negative 1,900. Here you have several minor pivot lows. This little pivot low, negative 1,800, negative 17, negative 2,400, negative 2,200, negative 18, negative 2,000, negative 17, negative 16. So you can see that the present decline off this high, and it's not much of a decline. I don't think it's 2%, even though it has been persistent. Let's take a look. I'm going to go from the top of the Labor Day Globex high. Okay, it's 2.1%, 2.2%. But again, it's generated no concern whatsoever as measured by breadth. Now, what's going to happen here? I don't know. But this certainly leaves open the door for some sort of capitulation prior to a rally. Another potential scenario. Now, there are actually two more potential scenarios. All right, let's one. The bullish scenario is there's a divergence. There's a divergence starting about here where the market made lower lows, but it made higher breadth readings. Okay, that this can resolve in a bullish manner. If that's the case, it's possible that we just do the next rip. And the retracements in this general area will be relatively shallow, and then we have the next chop and churn that occurs up in here. Okay, that's another scenario. A third scenario, and I actually would favor this one. This scenario that I just showed is what I think is the least likely, which the cynics among you may say, well, that's definitely the one that's going to happen then, and I can understand that. But the second scenario, I think, is that maybe we get a bounce, a strong bounce, and breadth gets way up here again. And then this is a secondary high, and this low is tested or taken out following that. So we should have better information on Monday, which is why I'm doing the webinar on Monday after the market closed. If you are not a member, consider signing up. You will get the webinar, which will be worth the $97 it cost. But you're also going to get updates for the next 30 days. And we're coming into a really, really important seasonal time frame where quite often we form seasonal lows prior to the Santa Claus rally. Hope you guys have a great weekend. Oh, one last thing. Do me a favor. If you have not already subscribed to the YouTube channel, please do that. And if you enjoyed the video, please like it. Have a great weekend.